Okay, so now you have to do a question on consolidations. Now, where to start? The following are some headings that you can use when doing consolidation questions. So we start off by doing an acquisition analysis comparing the fair value of the net assets and liabilities acquired to what we've paid for that investment to see whether there's a gain on a bargain purchase or goodwill that needs to be recorded. Second is then to, if there were any fair value adjustments required on acquisition date, to do the BCVR entries, BCVR being a valuation reserve on group level, similar to an asset revaluation reserve, and making adjustments to that revaluation as, for example, over time, if it's a depreciable asset, to recognize the depreciation, or when the asset that was revalued on acquisition is sold subsequently, we make adjustments for those. Okay, the next section is then to do the pre-acquisition entries. That is entries to eliminate the subsidiary's equity against the investment in the parent accounting records. The reason why we do that reversal is to so that we don't double account for the results of the subsidiary by including both the results of the subsidiary as well as our investment in the subsidiary. The basis entry for the pre-acquisition entries is prepared on acquisition date with subsequent adjustments if it affects pre-acquisition equity. The following heading is then inter-entity transactions. Because our consolidated results should only reflect the results from dealings with companies outside of the group structure. So from a group perspective, it should only be the realized profit. So therefore, any inter-entity transaction should be reversed. Throughout this, we should also take into consideration the non-controlling interest parties, if that is relevant to the scenario. So I'm now just going to have a look at one of the questions in the textbook. Question 16.6. I'm not actually going to do the question, but I'm just going to read through the question and highlight why that information was presented to you. Now, with any question, you should always start with the required first so that you know what you should look for when reading through the scenario. But in this question, we were required to prepare the consolidation worksheet entries. So it's the journal entries to be included in the consolidation worksheet. That will be used as preparation or in the preparation of consolidated financial statements. And then very important, what financial period we're working with, so 30 June 2016. Now, I always find it handy to make use of a timeline just to give an indication of where we are with regards to the information. So we see it starts on the 1st of July 2012. And we're now busy with the financial year end 2016. So there will be 2013, 2014, 2015. So that was year 1, year 2, year 3, and we're busy with the 4th year after we've acquired the subsidiary. Okay, now let's quickly read through the scenario. So on the 1st of July 2012, our acquisition date, Sculpture Limited, so that is the parent company, acquired all the share capital. So we're the only shareholder. It's a wholly owned subsidiary, and there's no NCIs to consider. We acquired all of the share capital cum div. So that's an important piece of information. It's relevant to the acquisition analysis. So make sure you understand what that means of Virgo Limited, the subsidiary. So giving in exchange 50,000 shares in Sculpture Limited, having a fair value at acquisition date of $5 per share. So that is our consideration transferred. Once again, we use that in our, first of all, in our acquisition analysis, but then also to see what is the value of the investment in the subsidiary recorded in the parent company's accounting records. Cost incurred in undertaking the acquisition amounted to $10,000. That's not a journal entry for the consolidation worksheet, but it's actually recorded directly in the parent company's accounting record when they settle the expenses or as they accrue for the costs. The dividend payable at the acquisition date was paid in September 2012. So that affects our pre-acquisition equity entry, and it relates to the dividend payable on acquisition date, and that relates to the cum div piece of information. It also affects our consideration transferred. Okay, we were then given the statement of financial position on acquisition date. So you can, let me just get a different color here quickly. 30 June 2012, so close enough to our acquisition date so that we can actually use some of these figures. So what's been given in our statement of financial position? It's the equity of the subsidiary on acquisition, liabilities, and assets. And you should know now that your assets less your liabilities equal your equity. So in our acquisition analysis, we'll start off with our equity, which is equal to our net assets at fair value, and then make any fair value adjustments that are required. For example, if some of the assets are not recorded at fair value. So let's read on and see what the question says. The recorded amounts of the identifiable assets and liabilities of this company at the acquisition date were equal to their fair values. That means no fair value adjustments are required with regards to our assets or our liabilities. Virgo Limited has not recorded an internally developed trademark, but the parent company valued this at $20,000. So there's an adjustment that we'll make to our equity figure to get to our net asset value valued at fair value. This is also important in terms of our BCVR entries, because that will be one of our BCVR entries that we need to make. Okay, it was assumed to have a 4-year life, so we're now in year 4, and that means that at the end of this financial year, this trademark will be fully amortized. Now, why is that important to know? Because that affects our pre-acquisition equity entry, the entry that we compile as step 3 in our consolidation process. Okay, so keep that in mind when you get to that stage. It will also play a part in the BCVR entry that we pass for the current year. So every year we'll pass the BCVR entries until the asset that we're working with has been fully depreciated or has been sold off to an external party, in which case we'll transfer that BCVR to equity. Okay, so that's going to play a role this year. One thing that I forgot to highlight in our statement of financial position is the fact that the subsidiary had goodwill recorded on acquisition date. Now, depending on your calculation for the acquisition analysis, it will impact what we do with this goodwill. If you recorded a bargain on a gain on a bargain purchase, it means that this goodwill will be written off as part of our BCVR entries, and that will be done every year as we prepare the consolidation worksheet. Okay, the tax rate is 30% on the 31st of December 2014, so that should be, this is 2013, 2014, so just get the yellow there. I think if I'm now right, that should be somewhere there. Virgo Limited paid a bonus share dividend from pre-acquisition profits. So that once again is going to impact your entry under step 3 for pre-acquisition equity entries. So see if you can identify what the effect on that would be. The dividend being 1 share for every 3 held. So for this question, you basically have to prepare the acquisition analysis, consider whether there's any BCVR entry still relevant at this stage, at the 2016. And there should be with regards to the trademark and possibly regards to the goodwill. Then to see if you can draw up the pre-acquisition equity entry on acquisition date, because that's going to be your basis for step 3, but then to be able to identify what in this period, sorry, only up till the beginning of the current year. Let me just maybe. So what in this period until the beginning of the current financial year, what transactions occurred that affects our pre-acquisition equity, and that requires an adjustment to this basis entry. Okay, now have a go at the question and see how you go.